Okay, excellent. Everything's in order. It seems like this has been recorded. So, as always, welcome. Thank you for attending, and thank you to FXU for hosting these sessions. We're going to talk about price action. Of course, we're going to talk about price action. Literally a naked chart, if you like. Just for reference, this is a 60-minute chart. The solid red lines, again, just for your reference, these are the day's highs and lows. So they don't, other than that, I'm not using them for anything other than a visual guide as to what price activity happens in the day. Right, okay, so we're going to talk about price action now. This is a strategy, it's also a concept. It's not a new concept, but I have put my own, or I think my own little twist and definitions on it. Essentially, the price action, what I call the price action sequence, it helps me identify phases of the market. So one of the things that most people sometimes struggle with is how to identify a trend or ranging market conditions. Now, when a trend is already established, it's quite easy to use indicators. It's quite easy to use indicators like moving averages to identify a trend. But at what point will a direction change, and what point will it start? And how do we know when price is in a consolidation? Because the consolidation will start before the moving averages flatline or a MACD flatlines. So we can know from price action what phase the market is in before any indicator will ever tell you that piece of information. So we're going to talk about, again, another foundation stone of my own trading. I use this concept that we're going to go through on a daily basis. And it really is one of the foundation stones of my own trading. So price action sequence, what is it? It's going to be useful to identify phases of the market. What is an uptrend? What is a downtrend? And at what point does price transition from up to down, or even, not forgetting the third phase of movement, into or from sideways or consolidation. So before we get going, we need to identify some definitions to help with this sequence. I'm using swing high and swing low definitions. So for me, a swing high, for example, is a bar, a single bar, or a candle. We've got candles on, but a bar that is preceded and succeeded by lower individual bar highs. So we've got a 3-bar combination, bar preceded and succeeded by lower individual bar highs. That for me develops the swing high, and the highest point of that 3-bar combination is the swing high. Similarly, swing low is a 3-bar combination as well. A swing low is a bar preceded and succeeded, so before and after, with the individual bars, the bars before and bar after, with higher individual bar lows. So this for me creates a swing low. So this for me creates a swing low. So with that in mind, they're the definitions. They're the two definitions that we need to have. A swing high, what is a swing high? What is a swing low? Now with that in mind, what we can now do is start to put some structure on the markets, or on price action, and hopefully identify the phases of movement. So just bear with me a moment. I'm just going to mark a few of these off. It's quite a straightforward definition. It's a mechanical definition. There is no ifs, buts, or maybes about what price is doing. Either is or is not making a swing high or a swing low. So let me just zoom in a little bit. There we go. So we have, at this point of the chart, that I've just marked off. I've just marked off several swing highs, several swing lows for the moment, just to get the ball rolling. So what we can do now is we can start counting these swing highs and swing lows. So it literally is, say what you see. Swing low. Another swing low here. Swing high, swing low, swing high, swing low. Okay, so nice and simple. Now let's put them in reference to the previous swing high or the previous swing low. So starting off again, swing low. This swing low is higher and the previous swing low. So this is a higher swing low. So we've got swing high here. So we just need to mark off the previous swing high. So there's the previous swing high. So this swing high where the cursor is now is lower than the previous swing high. So this is a lower swing high. Nice and simple, isn't it? Higher swing low, and there is the first higher swing high. Now why is that important? This is going to be important for identifying when the bias shifts from down on that movement down there, price making lower highs, lower lows. When does it transition to up? When price starts making higher highs, higher lows, price can be deemed to be, or can be said to be going up. And the first point in time that price does this is when price goes above this higher swing high here. So is everyone with the logic of the concept of what we're doing? We're trying to identify, effectively shifts in direction and identify the phase of the market. The whole pattern itself I would term as a bias change. You might know this as a 1, 2, 3 pullback. You might know this as a 1, 2, 3 rocks hook. Some of you might know this as a multi-point reversal. It's got lots of different names, so don't be confused if you know this as something else. Again, it's not a new concept. There's lots of different interpretations of this, but this is essentially as simple as I like to make it. So, at what points does the bias change? So we've got low. I've actually got a little bit of a crook in this sequence. We've actually got low, higher low, lower high, another higher low, and there's the higher swing high. So for a long direction shift, that higher swing high there, price goes above that higher swing high. The direction of bias is transitioning from down to up. Nice and simple. Now the way that I use this from a trading point of view is I actually use this pattern regularly to actually enter into the market as well. So my entry would be above the higher swing high. Typically I use this on the lower time frames at the moment. There's nothing wrong with it on any time frame. And typically I place my stop loss. Always I place my stop loss past the event that got me into the trade. So in this case it's the bias change. So typically I place my stop loss past the lowest point of the pattern. And obviously for a short, the highest point of the pattern. So that's it, that's the bias change. Price transition from down to up. Price goes above that higher swing high. Price action can be said as going up. So let's continue counting the sequence. We've got another higher swing high, higher swing low, and a lower swing high. Now that, if you notice in this case, the swing low and the swing high are on the same bar. That's fine, that's fine. So high, higher low, lower high, lower swing low. So if price went below that lower swing low here, the bias will change from up to down. And as we can see, that didn't happen. Now when would the pattern void? So I would consider a direction change below that lower swing low there where the cursor is. And the pattern for me would void when price goes past the highest point of the pattern there. So the highest point of the pattern, where the cursor is now. And if price moves above that level, then the pattern will void. Is everyone with me so far, and is there any questions for the moment? Stony silence. Okay, I'm going to assume then that everyone's fine with this. So, that is what I term as a bias change. That's what I term as a bias change. So, again, continuing with the... Yeah, it's been recorded, so if you don't get it first time round, the team at FX Street, I'm sure, will email the link out to you. So, again, it really is nothing more complicated than this, counting the sequence of events. So, that, again, a short direction change potentially setting up there, it voided, so the previous direction remains in effect. So, it's up at that point that we're up to for the moment. So, at what point does price transition again? Now, we've actually, again, if we count the sequence, we've got price making, again, just count the swing highs. Let's just scroll back behind the time. So count the swing highs. So this is where we were up to. So long direction bias, a short direction bias setup which voided. We can use, or I use this exact pattern for entries. So I can enter above the highest swing high with a stop loss below the lowest point of the pattern. I'll certainly do that in the lower time frames. We'll go through some examples in a moment. But just at its base level, we can use it to identify phases of the market movement. So upward direction continues to be up, and then again, say what we see. High, higher low, lower swing high, higher swing low. Hold on a moment. Has the phase changed? It's making swing highs and swing lows, of course, but it's not making new swing highs, higher swing highs, and neither is it making lower swing lows. So at this point of the chart, the phase has changed. It's changed from an upward trending direction making higher swing highs, higher swing lows, and price action at this exact point here, when that last swing low completes, has just told you that the phase of movement has changed from up to sideways. Now, if you want to put a label on this, you could call this a symmetrical triangle. Again, if we just do that just for illustration, we could call this a symmetrical triangle. I don't really concern myself with trying to put labels on the market anymore. And I'll show you why as well. Okay, so we could call this a symmetrical triangle, and a lot of people would mark that off as we just have done. But one of the things that I've come to learn many years ago was that the name that you call something, the name of a pattern, can change. As new information develops on the chart, we could call this, at this point, a symmetrical triangle. But even when price moves out of that triangle pattern, is the phase of movement still the same? Is price still in a consolidation? So what I prefer to do is, rather than try and worry about what name the consolidation is, whether it's a triangle, ascending, descending, a multitude of many different names to categorize what that consolidation is called. What I prefer to do is to just very simply identify price is range bound. It's range bound between and confined within the last highest swing high and the last highest swing low. That's where price is contained. So until price moves out of that containment, I don't need to worry about what the name of any pattern that might develop is called. Price is range bound. That's all you need to know. So until price moves outside of those boundary levels, price will remain range bound. And effectively, you cannot worry about counting each swing high and swing low while price is between those two boundary zones, because you already know price is range bound. Okay, does that point make sense? Does everyone happy with sort of the transition from trending to consolidation, and the fact that you don't really need to worry about what the name of a pattern is? It's a consolidation. Trade the breakouts. If it's trending, you're looking for a continuation. If price reverses, you've got reversal pattern inherent into the actual structure of this sequence. So we've transitioned from up to sideways, and until price moves through the boundary high or the boundary low, price will remain range bound. So we've got, again, what most people would call a breakout. When does price change from sideways to up? There's the breakout, there's the swing high. More specifically, there's your higher swing high. So should price go above that higher swing high, price will resume its upward trend. And that's your breakout. Again, this in itself is another tradable pattern. Breakout, pull back. If price goes above that high, price will be making higher swing highs once again, and the previous direction will resume. Menno, the question was how many pips to be higher. Me personally, I'm not concerned. It could be a fraction of a pip, it could be 1 pip. There's several ways that you could add filters into that. Some people, I do know, look for a closed past on whatever time frame that you're using, a closed past a specific, that boundary high. Personally, I don't worry about it. price action is telling me that is a higher swing high. There is no buts or maybes. It doesn't matter whether it's 1 pip, 5 pips or 50 pips above that level. It is making a higher swing high. End of story. There's no question about it. It is doing that. However, having said that, from a practical trading point of view, depending on how your personality as a trader, you might want to be aggressive, you might want to be conservative. I lean towards the aggressive side, if I'm honest. So you can add filters into that if you want to wait for a close past the boundary high. If you want to wait for that, there'd be nothing wrong with it. For a pullback, stop loss. Okay, so we've dealt with the bias change, entry, pullback. Now for this pullback here, so if you're going to, just assuming this single time frame entry without any fluff or additional filters or anything like that, for a pullback entry, or in this case a breakout and a pullback, entry above the pullback high would be the way that I would do it. The stop loss would go past the lowest point of the retracement after that pullback has developed. Now in real time, I am never going to know where that is in real time until the trade triggers. So I need to work out a void level, which is going to be the previous swing low prior to that pullback. So I would use that as my void level where the cursor is now, and that would void the pullback, and then I would restart looking for the entry pattern, as it were. So in this case, price did go past that previous swing low. If I was using that breakout pullback as my entry, that would void, and very simply wait for another breakout. That would be another way of doing it. So that would how I'd trade it. But just from the phase of movement point of view, price still needs to go above that higher swing high there before price is making, again, higher swing highs, higher swing lows. So kind of skirted round or flipping between using this from an entry point of view and also just generally the phase of movement. There's nothing wrong with either or either, but I'm sure you can see the possibilities of how you could weave this into whatever strategy you're using. It's a very simple, very powerful, very effective. Again, I use this daily. I'll go through some examples of trades that I've done today shortly. So price is range bound. Price is still contained within the boundary high and boundary low. You've got the high swing high there, and again at this point you could probably do one of two things: wait for a second breakout attempt, or wait for price to go through that higher swing high, which ultimately and eventually happens. So I'm sure we'll get the idea. So price, so attempted breakout through the low, a little bit of a news reaction, as you know there, if you think back early in the week. So a little bit of a movement through the consolidation low, swing low. Price doesn't go below the swing low, and continues through the swing high here. So the previous direction resumes, as we can see, quite effective. And again, it's very simple. Price making high swing highs, high swing lows. Let's talk about the transition from up to down again. So this is usually the sticking point. The easy part is seeing where price is trending. If it's already trending, it's very easy to see that price is making high swing highs, high swing lows, or lower swing highs, lower swing lows. It's very easy to see when price is already trending. But the transition from up to down, or from trending to sideways and out and back again, is usually where people get stuck. Now, again, a breakout, again, I think that's fairly easy to see, a breakout, pullback, and the continuation after the breakout. I think most people, generally speaking, are easy with that. But the sticking point in my experience, when I've trained people to do this, is when does price transition from an uptrend to a downtrend? So we'll go through this once more, and it's going to be a short direction this time. So we've got price, again, just marking off the sequence. High, higher low, higher high. Now we've actually got a slight variation of this now. We've actually got price making lower swing low. So a slight variation of the pattern we went through earlier. So what's happening this time, at this point? Say what we see: higher low, higher high, lower swing low. So the lower swing low and a higher swing high for the pattern is the secret sauce, if you like. So if price goes below that lower swing low, price will be making lower highs, lower lows. Now in this case, the lower swing high, because of the order in which the swing highs and swing lows developed, in this case, the lower swing low develops first. So the lower high, assuming it develops, will always be developing in real time. So that last lower high or that last higher low that completes the pattern always will be developing in real time. And you will never know that until the bias changes. Now the good news is we know at what point the bias will change. It's when price moves past the lower swing low for a short or a higher swing high for a long. So if price goes below that level there, the direction will shift. And if price goes above the highest point of the pattern first, then the pattern will void and you restart the counting sequence. So in this case, we've got the bias changing, the lower high developing, again, in real time. That lower swing high there will always be developing in real time. So two different types of pattern. I call the one on the bottom left here a regular bias change, which is where we get low, lower high, higher low, then the higher swing high. And that last higher low will always be developing in real time. In this case, I refer to this as an alternative bias change. We've got low, lower high, sorry, my apologies, low, higher highs, lower swing low. And that last lower high there where the cursor is, again, will always developing in real time. The key, the secret sauce is the lower swing low, the higher swing high. The first time that it does that, and when price goes past that level, the direction can said to have changed. Sure, we all know what happened next. So again, price continues to make lower highs, lower lows, and changes over. Again, I'm sure we all get the idea. So is everyone happy with the different variations of the bias change and the transitioning from up to down and down to up? Now in this case, obviously very briefly, price transitions to the downside. There's obviously opportunity to profit there. But again, we can see that very clearly here, just where the cursor is. Low, lower high, higher low, higher swing high, transition back up, into sideways, back to down, attempted to change direction up, and then pretty much flipped over, back down again. So with this knowledge now, this literally the sequence of events, the higher swing highs, high swing high, high swing low, lower swing high, lower swing low. And if price is making neither new higher swing highs or new lower swing lows, if it's making neither of those two things, then again, price is range bound. Don't worry about what the name of the pattern is. You will never know what the name of a price action pattern is until after it's completed. That's one of the things that I personally learned. Again, trying to trade in real time. Don't worry about the name of it, just identify it as a consolidation, trending up or trending down. There's three phases of movement, and very simply, this price action sequence is it's very powerful. I use it for my own entry, and it will help you identify phases of movement. So I'll just pause there for a moment. Any questions? Okay, then, a couple of questions. So the first one, do I go to a 1 or 3 minute chart? Market timer. So do I use a 1 or 3 minute chart? I actually use tick charts. It's approximately the same as a 2 or a 3 minute chart. I use an 89 tick chart. The tick data will vary from different data sources. So just be aware, I'm looking for an average tick bar to represent approximately a 2 or a 3 minute chart. If I wasn't using tick charts, I would probably be using a 2 or a 3 minute chart. So that would be my preference. So a couple of ways you can actually do that market timer. So do I enter into the market? So let's just say for a moment that this 60-minute chart is your higher time frame. Let me just scroll back, just bear with me. So let's just say for a moment that this, I've lost it, just bear with me folks. There we go. Okay, let's just say for a moment that this is your higher time frame. Just zoom in. So this is your higher time frame, just as an illustration, and this is the chart that you're taking your lead as a direction. So how could you do this? So one way of doing this would be to say, all right, well, there's the bias change. Should price go above the highest swing high, the direction will be up. Now, what you could then do would be to say drop down to a lower time frame, whatever your entry time frame preference is, and trade it like a breakout. When price on your lower time frame moves above that level, breakouts pull back, and it's a break of the bias change pattern, a break of a resistance level. So you could quite easily use that as your trigger level to take action from a higher time frame point of view, and drop down to your entry time frame and look for the exact same sequence. Price must already be pointing up as it goes through that higher swing high. So you'd be looking for a continuation, and that would be, again, a higher swing high above that level. So for example, it might be that this pattern here, you've got the breakout move, for example, and higher swing high. So there's your pullback, entry above the pullback high. But you're going to be doing that on the lower, you're using this exact same pattern that we see up here on this time frame, but you'd be using that on your lower entry time frame down here. Entry above the pullback high, but again, just on a lower time frame. So entry above the pullback high, stop loss past the lowest point of the retracement after the pullback, so it'd still be valid, this type of unfolding here. So your entry would be above the highest swing high. Stop loss would go past the lowest point of the retracement after that pullback develops, always past the event that got me into the trade. And again, this type of pattern you would be using on the lower time frame at the start of that new direction. So that would be how I would do that. Oops, press fast forward on the chart. So alternative bias change. So was the next question. So the next question was, can I just run through the alternative bias change once again? So the alternative bias change. Firstly, the only difference between what I would term as a regular bias change and an alternative bias change is the order of the sequence in which the swing highs and swing lows develop. So over here, bottom left. So over here on the bottom left, we've got low, lower high, higher low, and there's the higher swing high there. So in this case, a lower high and a higher low developed before the higher swing high. So the question was, can I repeat the alternative bias change? So at this point of the chart over here on the right, follow the sequence of events. Higher swing high, higher swing low, higher swing high, and there is your lower swing low. So in this case, the lower swing low developed before a lower high developed. And that literally is the only difference between the two things. If you want to think of it in a slightly different way, if you imagine a head and shoulders pattern, the left shoulder and head would be the alternative bias change. So you've got your left shoulder, head, alternative bias change with the lower swing low. And the head and right shoulder would be the regular bias change. So there would be your head, right shoulder, and then the higher swing high. So that would perhaps be another way of thinking about the same thing. So again, that's the only difference between the two patterns set up. Should we look at a live one? Rather conveniently, we do have a few live setups. Let's take a look at the pound yen. This developed just prior to us starting the session. So this is my regular setup. So looking at the pound yen, I've got a higher time frame which I've done analysis on. I've identified a location that I'd like to take a chart on. So if you remember the simple price action analysis that we looked at in the past, identify a location that you want to or would like to place a trade on. So we've got this location. Again, for anyone who's watched these sessions regularly, this is a location of interest for me. So this basically means that price has previously reacted quite strongly, and the balance of power over here where the cursor is on the left has changed dramatically from this location. So what I'm doing is that when or if price comes back to this location again in the future, I'm working on the assumption that price will, something significant will happen once again. So we've covered that in the past. It's been recorded. Simple price action and locations of interest. Find a location where historically price has proven to have moved quite significantly in the past. So that firstly to me is the location is good. I'm going to not go through the rest of my criteria, obviously that's proprietary. But what we can see here on the lower time frame, again, we've got the 89-tick chart, and again, price retraced to a trigger level that I've previously identified that I'd like to participate in. And what we can see is price making higher highs, higher lows, retracing up to my desired entry location. Say what we see: high, higher low, lower high, lower swing low, entry below the lower swing low, stop loss past the highest point of the pattern, and these just green lines just represent some targets. So this is like a scalper type entry with some initial small targets. So that's it. It's very simple. You know, this can be used on any chart, any time frame, any market, any instruments that you wish to choose. It's a very simple and a powerful and effective strategy, and again, I use it on a daily basis, folks. So any more questions for the moment? I've kind of shot myself in the foot a little bit, if I'm honest, folks. I've actually finished a little bit early. So any questions? Any requests? We've got 10 minutes. I will take any special requests. So Menno, is it still valid? Is it stay below the high? So I'm not sure what you mean by that. I think you mean the stop loss, entry and stop loss. I'll just go through it again. So simple, we see high, high, low, lower high, lower swing low. So the way that I do this is entry below the lower swing low. So the lower swing low for me is at 61. Now the way that I do that is at least 2 pips away. I then personally like to round down to a whole or a half number. So like 05, 10, 15, 20, they're whole or half numbers. So my actual entry level, my entry location is at 130.55. That was how I would do that. The stop loss goes past the highest point of the pattern, so above 74. So I'm looking at a bid chart, so I need to factor in the spread. So 74 plus 2 plus my spread, and then again I like to round up to the whole or the half number. So 130.80 is where my actual stop loss location would go to. I use stop entry orders at must. So what type of orders do I use? I use stop entry orders. Targets, I use limits. So 4 bars later it's lower. Yeah, 4 bars later it is lower, and several bars later it's lower. So again, just to reiterate, my entry is below the lower swing low. And that lower swing low, you can just see there where the cursor is at 61. So I'm going to enter below 61. The way that I do that is 61 minus 2, and I then like to round down. So my physical entry location is at 130.55. Now that might trigger 2 minutes later, 5 minutes later, 10 minutes later, 20 minutes later. Doesn't matter. So my entry is there. The void level is the same as the stop location. So if price goes above that highest swing high there, the pattern will void, and I will restart the process of looking for that bias change. The trade triggers, the stop goes past the same location, so 74 plus 2 plus the spread rounded up gives me 80. And that's where my physical actual stop loss would be. Targets are based on volatility. For me, they're based on volatility. Rob, the recording, I'm sure it'll be posted out to you when the team at FX Streets have finished processing it. But I do have my own recording. I've done this several times in the past, so you can. So there's the link to an article version. There's several videos on there, but this particular recording, there's obviously different information in this. We've gone through a variety of different topics in relation to this. But that article that I've just posted is the basic outline. but in this particular recording, there will obviously be additional information that's not on there. Paul, am I going short because I'm going short because you're going to laugh at my answer. I'm going short because price is going down, not because the trend is down. Thinking back to the first comments, the location, find a location on the chart that I'd like to participate in. This blue area here, or the blue and red areas, these are all locations on the chart based on simple price action. Again, that's been previously recorded. And there's also a recorded session on my own site as well. But these locations are where there's been significant shifts in the balance of power. That basically means that there's been a hell of a lot of money flow coming into the market at this particular location, just where the cursor is. So that location there where the cursor is, there's been a lot of money flow coming in, which has caused a strong movement. So when or if price comes back to this location, I'm going to be interested. Now, notice the wording. I'm not saying this is support or the red locations are resistance. I'm saying that this is where I think something will happen. So I'm not trying to develop an opinion or a bias. So with the location good, it was going down. I set a long and a short trigger level that's been pre-identified, and price was going through my short trigger level. So these locations allow me to be a little bit more aggressive. Should price go down, I'm going to be a seller. Should price go up through a predefined long trigger level, I'm going to be a buyer. That's it. Simple as that. So why short? It's going down. Honestly, that is nothing more complicated than that. Why do I look at 480-minute charts? Why not? Durando, why not? Higher time frame, personal choice. If you're a scalper, you might want to use a 60-minute chart. If you're a position trader or a longer-term swing trader, you might want to use daily or weekly charts. It comes down to what your personal objectives are for trading. So Durando, I'll throw the question back. Why 480-minute charts? What's your objective? How are you going to achieve that objective? I'm a kind of a combination between scalping and short-term swing trading, so between 1 and 3 days are my time horizons. But 480-minute charts, why 480-minute charts? It splits the day up into the 3 sessions, the Asian session, the UK session, and the US session. I appreciate there is overlap between all those sessions, but you know, if you think about it, we've got, if we were trading index futures, the FTSE, the DAX, the stocks, Euro stocks, CAC, whatever, a day is typically around 8 hours. So we've got a 24-hour market with 3 8-hour sessions. So there's actually, compared to most other market trading, there's actually 3 days worth of data in a single day because it's a 24-hour market. So why 8 hours? I think it's a little bit more advantageous compared to a daily chart. That's my view. That's my preference. So any final questions, folks, before we wrap this session up to its conclusion? Question there, do I use Elliott wave analysis? No, I don't. Do I trade from the chart? You can trade from the chart, Rob. Depends on your platform. Personally, no. Actually, no, I don't. I like to use order tickets, Rob. I'm old-fashioned. When I started that, I didn't have the option to trade from the chart. So you kind of develop habits. This is one of the things, this kind of dictates your personality of what you prefer when trading. The option just simply wasn't available for me when I started out. So I developed a preference to do things a certain way based on what was available to me. And I just like to do it with order tickets. You can trade from the chart. There's lots of software that allows you to, say, right-click and set an order very, very quickly in that way. But again, I've got my routine. I've been doing it the way that I do it for many, many years. And that's, again, this comes down to personal preference. What do you prefer to do? Right, folks, with all that being said, thank you very much for your time. Thank you very much for listening. Once again, there is the price action article if you want to get a heads up on that before the team at FX Street process this video. That should be ready. I would imagine it'll be ready in a few days. They've got very fast turnaround time, and all the additional things that we covered outside of my article can also be viewed at your own leisure. We also talked about very briefly on simple price action and those locations of interest that we very briefly touched on. That again has been pre-recorded. You can see the previous FX Street sessions there, and there's also an article there that if you want to see my outline of. There's text and video there as well. But other than that, folks, thank you very much for your time. Thank you very much for listening. And as always, let's thank the FX Street team for providing such a wonderful site for our traders to get together. Whatever you're up to this weekend, have a fantastic time, and I will see you on the next session. If you've got any questions, again, please feel free to email me. You can contact me through the website, or through my website. But yeah, please feel free to contact me with any follow-up emails. If there's any questions I've missed, I'll private message them back to you. Right. Have a great weekend, folks.